Total non-current assets, which is another name for net fixed assets. Uh, from end of September 22 to 23, it actually decreased by how much? About $8.3 billion. I don't have to calculate the next one. So you're thinking, did Apple not make any capital expenditures? That kind of sounds unlikely, right? But think of it this way. If Apple had made zero capital expenditures and they didn't sell any of the existing fixed assets, their net fixed assets would have shown a decline. Why? At the end of September 2023, I had $217 billion worth of fixed assets. But during that 1 year until the end of September 23, there's going to be some depreciation. I haven't done anything new, but that depreciation alone is going to take my net fixed assets down. So to figure out how much I spent, I need to add that back up. And we can figure that out from the cash flow statements. Looks like Apple spent or Apple charged $11.1 billion in depreciation. Well, their net fixed assets went down by about 9. That means they actually spent about $2 billion in new fixed assets net. And in a problem, I call this thing at book value on purpose. Suppose you bought $1 million worth of new machinery and equipment, but you also sold some of the existing machinery, maybe just for scrap value for $100,000. But in your books, it was already fully depreciated. In that sense, you haven't sold anything. That $1 million is just profit you made, okay? That's going to go to your net income. But in terms of net capital spending, it was worth 0 on the books. So you sold them, nothing changed. If it was worth 100,000, then you sold something worth 100,000. Whether you sold it at 50 or 200 doesn't matter. It's the book value of the sales you made that matters. So depending upon the problem, you could calculate net capital spending either through change in fixed assets plus depreciation, or purchases of new fixed assets less sales of existing fixed assets at their book value. And change in net working capital, change in current assets minus change in current liabilities. The reason we take out both net capital spending and change in net working capital out of operating cash flow, remember, cash flow from assets is the amount that you're free to distribute between your shareholders and your creditors. Operating cash flow tells you how much money you made, but some of that money you're spending on new capital, which is the net capital spending. But, net working capital is technically also capital, but it's short-term capital. You can think of that as, net capital spending in short-term assets. whatever you have left. Let's see for Apple. Their current assets increased by about 8 billion. Their current liabilities decreased by about 8 billion. So change in net working capital is 16 billion. So they spent 2 billion in fixed capital, about 16 billion in short-term capital. We kind of view that as a short-term capital because remember what's in current assets: inventory, accounts receivable, and cash and similar stuff. These are stuff that you need to finance. All right. An alternative way to define CFFA. This is the uses of cash flow definition is equal to cash flow to shareholders CFTS plus cash flow to creditors. So my cash flow from assets is $10 billion. Maybe I gave 2 to my shareholders and the other to the creditors. Cash flow to shareholders is simple. Cash dividends minus net new equity sales of stocks, stock minus repurchases of stock. If a company issues new stock and sells them in the market, whether secondary or primary market, doesn't matter, that's going to create positive net new equity. Sometimes companies repurchase their own stock. For example, after the last statement, NVIDIA announced that they're going to buy back $50 billion worth of shares. That would be negative net new equity. Instead of selling new stock, you're buying back existing stock. You can return money to your shareholders 2 ways. You can directly pay. They can say, here's $50 billion, do whatever you want with it. Or you can say, I think my stock is cheap, so I'm going to go and buy back the stock from the market. Either way, your shareholders get that $50 billion. Cash flow to creditors is net interest expense minus net new borrowing. How do you give cash to your creditors? You either pay them interest or you repay an existing debt. Okay? Repaying an existing debt is negative borrowing. That's why we have a negative number in there. If you borrow more money, then cash flow to creditors could be negative. Remember, Cash flow from assets, cash flow to creditors, cash flow to shareholders, they could be of any sign. So if you make a calculation and find that cash flow to shareholders is negative, do not assume that it's the wrong number. It could be wrong, but that's not the reason. Under certain circumstances, it could be. For example, if I told you that company did not issue or repurchase any shares, based on that, you can rule out negative cash flow to shareholders because net new equity is zero and dividends cannot be negative. You cannot go to your shareholders and say, instead of me giving you money, how about you give me money for no reason whatsoever? That would be negative dividends, right? Similarly, in most cases, cash flow to creditors would be positive if there is no net new borrowing. You can think of net new borrowing roughly speaking, change in long-term debt. You know, how much that has changed. I have about 10 minutes, so let's do a few problems.